Watch this number. $1.4 trillion flowed into China, while the trade war headlines screamed decoupling and economic war. If that sounds impossible, that's the point. Money doesn't follow speeches, it follows exits. And this is the kind of exit signal that only appears right before a regime shifts. This video is not about politics, and it's not about which country you like more. It's about a repeatable pattern that shows up whenever a global system starts cracking, and it shows up long before the public realizes anything changed. In the next few minutes, the mechanism will be laid out in 4 stages, so the story stops feeling random. Then it gets proven with 3 fast historical snapshots, because patterns are only real if they repeat under pressure. After that, the timeline snaps back to 2018 to show why the trade war and the money flow weren't opposites, they were layers of the same event. Because there are always 2 layers, the theater layer that keeps you watching and the capital layer that quietly moves first. Once the capital layer moves, the incentives of the entire system change and headlines become noise. That's why 1.4 trillion isn't a statistic, it's a map of where the next decade is being built. And if this pattern is correct, the most expensive mistake is waiting for confirmation from the same people who missed the signal on purpose. Stage 1 is always the same. You create a money machine, usually a central bank structure, that can expand credit faster than real production can grow. At first it looks like stability because the new money arrives as growth, and almost nobody notices the trade being made. The trade is simple, convenience today in exchange for fragility tomorrow, because debt expansion becomes the system's default fuel. Stage 2 is when that fuel becomes policy, and the machine stops being a tool and starts being the strategy. Debt finances wars, programs, bailouts, and bubbles, and the winners are those closest to the first drop of new money. This is the phase where the headlines celebrate progress, while the balance sheet quietly becomes the real government. Stage 3 is overextension, when the math starts to resist and the system needs larger interventions just to stay where it is. At that point, control becomes reactive, rate cuts, emergency facilities, new liquidity programs, and promises that this time it's contained. But the public doesn't need to panic for Stage 3 to be real, because Stage 3 is about incentives changing inside the plumbing. You see it when insiders stop acting like builders and start acting like movers, rotating toward safety and optionality. Stage 4 is the pivot, when the same capital that benefited from the old regime quietly front-runs the next one. This is when the narrative and the money fully diverge, because the narrative must keep confidence alive while exits are still possible. So the public hears temporary and strong fundamentals, while the capital layer hears get out first or pay later. That's why the 1.4 trillion matters, because it behaves like a stage 4 footprint, not a random portfolio decision. And the key point is this: you don't have to prove a grand conspiracy to recognize a consistent pattern of behavior. All you have to do is watch what capital does when the incentives flip, because capital votes before people do. 1694, Britain is cornered by war costs, so a new deal is invented: lend the state money and get a private engine that can expand credit as the nation's bloodstream. That engine looks like salvation at first because it funds power fast and makes the empire feel unstoppable. But the hidden cost is structural. The system learns to survive by expanding debt, not by expanding real output. As long as the empire is rising, the trick feels like prosperity, because everyone confuses new credit with new wealth. Then over decades, the burden grows and the economy starts losing ground to newer, faster industrial rivals. That's when the stage 4 behavior appears. The same capital that built the old center begins funding the next center. British money pours into American railroads, steel, and industry, not because Britain is weak overnight, but because the next engine is stronger. This is the part history books underplay. Decline is rarely announced. It's financed away until financing no longer works. So the public keeps believing in permanence, while the builders quietly turn into movers. And once movers dominate, the old story becomes a comfort blanket, not a map. Think of it like a lighthouse with a dying bulb. Ships still see the tower, but the smart captains change course anyway. That's why capital migration is such a powerful signal. It happens before the collapse becomes a headline. It's not about predicting the exact day the pound loses status. It's about noticing the decade the incentives flipped. By the time the official breaking point arrives, the positioning is already done, and the late money pays the bill. This is the template we're going to reuse in the next chapters. Build the system, ride the boom, then move before the crowd understands the game changed. And once you see that template, the 1.4 trillion story stops looking like a mystery and starts looking like a replay. Germany after World War I is what stage 3 turning into stage 4 looks like at maximum speed. The state is trapped between impossible obligations and domestic politics, so it chooses the only lever it can pull quickly: expand money and credit. At first, it's framed as emergency management, but the market reads it as a signal that the currency is no longer the anchor. Once confidence cracks, prices stop behaving like prices and start behaving like a countdown timer. The public experiences it as chaos, but underneath it's a clean mechanism. More printing forces more selling, and more selling forces more printing. Then the truly brutal part appears. The middle class holding savings in the currency gets erased, while holders of real assets and foreign currency survive. In that environment, a reset is not a rescue. It's a restructuring, and restructuring always creates new owners. Capital doesn't wait for the official announcement because the official announcement comes after the damage is done. So you get stage 4 behavior. Outside money arrives to buy what panic is forced to sell at prices that only exist during systemic stress. The story the public hears is stabilization, but the story the capital layer lives is transfer of control. This is why hyperinflation is never just about money, it's about bargaining power, because whoever can still price assets becomes the system. And it's why the most dangerous moment is not the first bad headline, it's the moment people accept that saving in currency is pointless. Once that psychological line is crossed, velocity becomes the weapon and time becomes the tax. That's when a new unit gets introduced, and everyone pretends it's a fresh start, even though the ownership map is already redrawn. Keep that image in mind, because the modern version of reset doesn't need wheelbarrows of cash. It can happen digitally, quietly, and legally, while the public is distracted by the wrong layer of the story. August 1971 is the moment the rules changed, because the system promised gold backing while printing more claims than it could honor. Once the gold window closed, the constraint disappeared, and the dollar became a story enforced by policy rather than a claim on a medal. That sounds abstract, but the practical meaning is simple. The system can now solve every crisis the same way. More liquidity, more debt, more time. In the short run, it works, because confidence is a habit, and the world keeps using the same rails it used yesterday. But the long-run cost is compounding, because when you remove the brake, every political promise becomes financeable until the math says no. This is where the pattern becomes dangerous. The debt doesn't have to be repaid, it only has to be rolled, and rolling becomes a permanent dependency. So every decade needs a bigger intervention than the decade before, just to keep the machine from stalling. That is why temporary measures almost never stay temporary once the system learns it can survive by expanding. The reserve status delays the pain because external demand absorbs the inflation and converts it into asset booms instead of immediate collapse. But reserve status also creates the trap because the world's savings become your funding, and your deficits become the world's exposure. And the moment foreign holders begin treating your currency like a risk asset, the entire feedback loop flips against you. That's the bridge from 1971 to our 1.4 trillion signal, because stage 4 always begins as a portfolio decision, not a press release. When the biggest institutions position early, they're not predicting tomorrow's headline, they're pricing the next regime. So the point of 1971 is not nostalgia, it's a blueprint. Once the constraint is removed, the system only knows one direction. If the audience remembers one thing here, it's that modern resets rarely look like collapse. They look like rule changes that never get reversed. And those rule changes create the exact conditions where capital quietly chooses the next center before the public even knows there was a choice. Now we jump to the new rails because stage 4 only becomes permanent when the alternative infrastructure is already usable. This is the part most people miss, because power doesn't change hands when someone makes a speech. It changes when settlement can happen without permission. Think of rails as the invisible layer under trade. Payment systems, clearing, custody, index inclusion, and the rules that decide what institutions must buy. When those rails shift, capital doesn't need a headline to move. It needs a route with low friction and legal clarity. China spent years building routes that look boring on the surface, but they do one thing perfectly. They let large pools of money operate inside China at scale. That's why the 1.4 trillion isn't a one-off. It's a footprint that shows the rails were ready enough for institutions to commit. And once the rails are in place, the story stops being, is China rising? And becomes, how fast can flows compound? Because institutional flows compound quietly, benchmark changes, passive mandates, custody approvals, and index weights that force allocation. The public calls that normal market exposure, but the system experiences it as a one-way channel with a widening mouth. Meanwhile, the theater layer keeps shouting conflict because conflict sells, and conflict gives cover for the capital layer to reposition without scrutiny. So the real question is not whether decoupling was sincere. The question is what mechanisms made coupling easier at the exact same time. If you want to understand the next decade, stop watching speeches and start watching the pipes. Who controls the benchmark? Who controls the clearing? Who controls access? That's also why modern transitions don't need a visible collapse. They can look like a gradual reweighting that becomes irreversible. At a certain point, even if politics flips, the plumbing doesn't, because trillions are already routed through the new system. And that is the warning embedded in the 1.4 trillion number. Once capital learns a new route, it rarely unlearns it. In the next chapter, we'll pin this to the 2018 to 2020 timeline and show the specific switches that made the flow look inevitable in hindsight. The trade war was the theater layer, loud, emotional, built for cameras. But the capital layer runs on different incentives, and it moves when the plumbing gives it a path. So here's the rule. If politics says decouple, while capital flows say integrate, believe the flows. Because speeches can threaten, but settlement systems and index rules can compel. This is how coupling can accelerate during conflict. Conflict creates cover, and cover reduces scrutiny. The public debates tariffs, while institutions quietly line up the approvals, custody, and access that make allocation possible. That's why the 1.4 trillion number matters more than any headline. It's behavior, not messaging. Now pin it to the real question. What changed in 2018 that could force trillions to move, even if managers didn't want to? Because the biggest flows aren't discretionary. They're benchmark-driven, mandate-driven, and risk model-driven. If an index provider changes the recipe, passive money follows the recipe automatically. And if regulators open doors for foreign firms, the legal clarity problem disappears and scale becomes possible. So the contradiction isn't mysterious. The theater layer performs resistance while the capital layer executes integration. This is also why blaming a single bank misses the point. The system is designed to route money where the rules point. Once that routing begins, it compounds. More inclusion leads to more liquidity, which leads to more inclusion. That's what stage 4 looks like in real life. The narrative stays national, the money becomes transnational. And now we can do what most people never do. List the exact switches from 2018-2020 that made this flow look inevitable in hindsight. Switch 1 was index inclusion because it turned China exposure from a choice into a rule-driven allocation. June 1st, 2018, MSCI began including China A shares, and that single methodological change mattered more than 1,000 headlines. Because once a market enters a benchmark, passive funds and benchmarked mandates have to follow the benchmark, not the news cycle. Switch 2 was timing. July 6, 2018, the first tariffs hit, and the theater began right as the allocation rails were being installed. That overlap is the tell. Politics can argue on the surface while the plumbing quietly standardizes underneath. Switch 3 was access. The moment foreign institutions can operate with clear rules, flows stop being possible and become scalable. Switch 4 was custody and clearing. Boring words, but without them you don't get trillion-dollar commitment, you get headlines and small bets. Switch 5 was benchmark weight compounding. China's weight inside the MSCI Emerging Markets Index rose to 43% by October 2020, and weight is gravity for institutional money. Once weight rises, allocation becomes mechanical. New inflows by the constituents, liquidity improves, and the next weight increase becomes easier to justify. That's how the 1.4 trillion footprint forms, not as one big decision, but as many forced, repeatable micro-decisions stacked together. This is also why arguing they shouldn't have invested misses the mechanism. Most of the machine doesn't care what anyone should do. It cares about mandates, benchmarks, risk limits, and operational rails that compliance teams can sign off on. Put those switches together and the trade war becomes background noise. The theater says decouple. The system quietly builds coupling, and that's the real warning inside the number. Once capital learns a route, it doesn't need permission to keep using it. So if the goal is to understand what happens next, the question isn't what will politicians say, it's what will the benchmarks and access rules change next. Because stage 4 becomes permanent when the route is routinized. And by 2020, that routinization was already visible in the footprint.